This is my kitchen table, and it's also my filing system. Over much of the past 3 decades, I've been an investor. The highest calling of mankind, I've often thought, was private equity. And then I started interviewing.
While I watch your interviews, I know how to do some interviewing.
I've learned in doing my interviews how leaders make it to the top.
I asked him how much he wanted. He said $250. I said fine. I didn't negotiate with him, and I did no due diligence.
I have something I'd like to sell, and how they stay there. You don't feel inadequate now because being only the second wealthiest man in the world, is that right? A number of years ago, I hired a young investment banker who had previously worked in the government and also been a lawyer. His name was Jay Powell. I thought he was a very impressive person, and he did a terrific job in my firm. But he left to go back into public policy work. He's now the chairman of the U.S. Federal Reserve Board. And in that context, he has to deal with the most important economic issues now facing the country. Let me begin by talking about the state of the economy. Your public statements to date in recent interviews makes it sound like you feel the economy is in reasonable shape to go forward from here, and you're expecting growth of 5 to 6% this year. Is that a correct announcement of your views?
Generally, yes. I would say that the economy at this point does seem to be at a bit of an inflection point, and that makes sense with ever more widespread vaccinations, with strong fiscal policy, with continued support for monetary policy. You see the economy opening. You can see ridership on airplanes going up and people going back to restaurants. I think the March jobs report that we recently got shows what that can look like, which was close to 1 million jobs in a month. So I think we're going into a period of faster growth and higher job creation, and that's a good thing. I would point out there's still risks. In particular, I would say the main risk is that we'll have another spike in cases, perhaps in one of the virus strains that may be more difficult to treat. Now, we don't see that yet. We do see cases having moved up a bit, but that's something we need to be careful about, and I think we'd be wise to keep wearing masks and being socially distant at least for a while longer.
The debt is pretty high, 27 trillion or so, and the annual deficit is now about 2.5 to 3 trillion or so. Is that a concern to the Fed in terms of impacting inflation?
So yes, in the over time and in the longer run, the U.S. federal budget is on an unsustainable path, meaning simply that the debt is growing meaningfully faster than the economy, and that's by definition unsustainable over time. It's a different thing to say that the current level of the debt is unsustainable. It's not. The current level of the debt is very sustainable, and there's no question of our ability to service and issue that debt for the foreseeable future. I would also say, though, that as a nation, we will have to eventually get back to a sustainable path. That is something that is best done in very good times, when the economy is at full employment and when taxes are rolling in. This is not the time to prioritize that concern, but it is nonetheless an important concern that I believe we will ultimately have to return to, again, when the economy is strong.
Now, you have previously said, I just want to ask you if you feel the same way now, that currently you do not expect the Federal Reserve to increase interest rates before the end of 2022. Is that a correct view of what you've said?
So here's what we've said. We've said that we would expect to keep interest rates where they are today until 3 particular outcomes are achieved in the economy. The first is that the recovery in the labor market is effectively complete. The second is that inflation has reached 2% and really reached it, not just sort of tapped the base, as I like to say, but has reached it sustainably. And the third thing is that inflation is on track to run moderately above 2% for some time. Those are the tests. So we are really focused on the progress of the economy toward those goals, and not on a particular time frame. When we get those 3 boxes checked, that's when we'll consider raising interest rates, and that's when we'll raise interest rates. Until then, we won't. So what you're referring to, I think, is we all write down these projections every quarter in the March, June, September, and December FOMC meetings, write down individual projections, and we submit those, we tabulate them and publish them. And most members of the committee did not see raising interest rates until 2024, but that isn't a committee forecast. It isn't something we vote on or act on as a group. It really is just our own assessment. And so I think there's a tendency of markets to focus too much on what we call the dot plot.
Okay, but based on what you know to date, you would not expect to increase interest rates before 2022, or you're just not saying that yet?
Well, before 2022, that would be this year. I think that would be highly unlikely. I don't talk about particular dates. I don't think there's any use in that. So, but it really is outcome based.
Well, let me ask you, last time the Fed did increase interest rates, it did so by a little bit, and then it started shrinking its balance sheet a bit. Do you have any view on whether that's the right way to proceed when you begin to increase interest rates? Should you increase interest rates and then shrink the balance sheet later, or should you begin to shrink the balance sheet and then increase interest rates? Do you have any view on whether one policy or the other is better?
So what we did after the global financial crisis was first we were buying assets, and then we gradually slowed the pace at which we were buying treasuries and mortgage-backed securities, and then we held the balance sheet constant for a while. After that, we started raising interest rates. We raised them gradually. And at some point we held the balance sheet constant. So we don't sell bonds into the market, and we either, when they mature, we either reinvestment or that we allow them to run off. So that's what we did last time. I think if you look at the sense of our guidance, it is that we will reach the time at which we will taper asset purchases when we've made substantial further progress toward our goals from last December when we announced that guidance. And that would in all likelihood be well before the time we consider raising interest rates. We haven't, voted on that order, but that is the sense of the guidance, is that it would work in that way.
In other words, you are likely to follow the same policy of not selling into the market the bonds you already have or other securities, but just let them mature, and then that's the way you'd shrink your balance sheet.
These are questions which lie ahead of us, but essentially, though, I would say it this way. The first thing we do is we say that we will gradually reduce the pace of our purchases, and then when the purchases go to zero, the size of the balance sheet is constant, and when bonds mature, you reinvest them. Now, then another step, and we took this late in the day, the last cycle, was to allow bonds to start to run off. And we haven't decided whether to do that or not. We didn't then, and I don't think we now would ever actually sell bonds into the marketplace.
You mentioned inflation. Let me talk about that, or ask you about inflation. The Fed for quite some time has tried to get 2% inflation, but really hasn't been able to get 2% inflation in our economy. Why do you think it's been so difficult to get inflation at 2% or higher? When I worked in the government many years ago, we had double-digit inflation. I don't think we're getting that again. But why is inflation so hard to get when we have large deficits and a lot of government spending?
So the economy has really changed since those days. That's when I was in college. And I think people generally attribute the quarter of a century of low inflation that we've had to a number of factors. One is globalization, one is spread of technology, another is demographics and an aging population. All of those tend to lead to lower inflation. So what we have, in fact, since the global financial crisis for the last decade, you've seen central banks around the world really struggle to reach a 2% goal, and in some cases, are fighting outright deflation. The reason that's a difficult thing is that reduces the scope of central banks to react to the economy when it turns down, which can lead to still weaker economic outcomes, lower interest rates, lower inflation. So you can get into a cycle, if you will, that's not a productive one. So we really want inflation to be at 2%. We want it to average 2% over time, and that means that we want to overshoot 2% after we've been through a period moderately and for some time after we've been below 2% for a while.
Is there anything you think the Fed should be able to do to help people who are really suffering in the pandemic?
I think they need to be in the room with us as we make our decisions about monetary policy.
So let me ask you about the situation with respect to a couple issues you've talked about, climate change, for example, or racial inequality. The Fed has not historically been somebody that's supposed to be focused on climate change, and you're focused on the unemployment rate, but not under the statute, whether it's minority unemployment rate or white unemployment rate. How do you assess these issues that are not really in your statute, but are now important in terms of determining how the economy is moving forward?
So they're two different issues, and there are differences and similarities. But the point is, both of them we see only through the eyes, through the lens of our existing mandates. We haven't gotten any new mandates. So take climate change, for example. The reason we're focused on climate change is that our job is to make sure that financial institutions, banks, particularly the largest ones, understand and are able to manage the significant risks that they take. And the public will expect us to do that. Climate change is just another one of those risks. And increasingly, the large banks very much realize that. If you talk to leaders of these large financial institutions, they're very focused on what climate change is going to mean for their business model over time. So it's within the scope of that mandate. It's similar with inequality. We have these persistent disparities, racial, gender, and other disparities in economic outcomes in our economy, and they kind of hold the economy back. You know, we all want an economy where everyone has the ability to contribute to and benefit from the prosperity that we have in our great economy. So really, our focus is on the gaps that we face, and we call them out. We talk about them. We've tried to incorporate into our monetary policy framework the thought that that maximum employment, our statutory goal, is a broad and inclusive goal. That's a reference to those issues. And also, I think we now realize that unemployment can go low for quite a long time without inflation being a problem, which will also tend to help those groups. On that, I would just stress, of course, we can't be the primary policy organization that treats either climate change or inequality. We see it through the lens of our existing mandates, but those are very much issues for elected representatives and for other parts of the government, more than they are for us.
When you come to work sometimes, you see people in tents, living in tents, homeless people living in tents. Your mandate is not to go solve that problem necessarily, but is there anything you think the Fed should be able to do or should be given more power to do to help people who are really suffering in the pandemic?
We're definitely not seeking any new authority, nor are we, as I mentioned earlier, we're not the agency that has the most direct authority over that. I just happen to see it, though, right here on Virginia Avenue. There have often been a couple of tents at this end of town where there's some open space. But now it's big. It's a lot of tents and it's a lot of people, and you can't miss it. You drive by and you think, and it has to be because of the pandemic. It just has grown a great deal, and it really struck me it strikes me every day as I go by it. So, how does that play into what the Fed does? I think we need to keep those people in mind. Really, we don't have tools that deal directly with them, but those are people. Many of them probably were working in February of 2020 before the pandemic hit. And I think they need to be in the room with us as we make our decisions about monetary policy. We need to be thinking that it's not just the headline in the aggregate, it's also the people who are at the margins of the economy. We just keep them in mind.
Okay, let's talk about fintech. Since you first got into the financial world, the fintech revolution has really changed banking and financial services. How does the Fed regulate some of these new fintech companies that are really not subject under the traditional rules to your regulation? Are you worried about your inability to kind of control some of these companies that might have an enormous impact on the economy?
In the financial area, the key thing is that equal activities, the same activities should be regulated the same way no matter where it is, what kind of business it's in. That's one thing. Another is it needs to be regulated in a way that gives consumers and users of that service the protections that they need. And so they have to understand what the risks are of what they're doing and that sort of thing. So I think with the growth of the non-bank financial players, we have some work to do to understand and deal with those challenges. In the meantime, we have the legal authority that we have over banks, really, also over some of the payment utilities, and we'll use that. But we don't have authority over many other companies that are now very much engaged in payments business and dealing with the public. And I think Congress is looking at the question of whether there's enough there, whether the sort of regulation and supervision that they need is really there.
Well, related to that would be cryptocurrencies, which is not quite fintech. Maybe some people might say it is, but cryptocurrencies have blossomed, mushroomed, depending on your observation of the size of it. It's hard to know exactly how big it is. Are you worried about the impact of cryptocurrencies in terms of the impact in the economy and the ability of people to use these things for nefarious purposes?
So a couple things. With We think of them more as crypto assets because what people call cryptocurrencies, they're really vehicles for speculation. No one is using them for payments, for example, like the dollar. What they're using them for is to speculate. It's a little bit like gold. For thousands of years, human beings have given gold this special value that it doesn't have from an industrial standpoint, but nonetheless, for thousands of years, they've done that. So Bitcoin is much more like that, and the cryptocurrencies are much more like that. They're not really being actively used as payments.
I think you said recently the biggest problem that you're worried about now is cyber attacks and so forth. Can you elaborate a little bit more why you are so worried about it, and how does the Fed protect itself?
Cyber is it's the new frontier, and that's not a new insight. We spend a great deal of time and money, making sure that we are resilient, making sure that the banks, they spend a lot of time and money. As I said before, it's one of those things where you never feel like you've done enough.
Let me ask you a little bit about the FOMC. People probably don't really know how it works that much, but how many members are there of the FOMC?
So all 12 Reserve Bank presidents and all of the sitting governors, which is currently 6, are what we call participants in the FOMC. So it's the Federal Open Market Committee, and we meet 8 times a year. We're doing it virtually now, but I do it from this beautiful boardroom we have upstairs.
So in the Supreme Court, when they have conferences among the members, I think the Chief Justice gives his view first, and others, according to seniority, give their views. How does it work at the FOMC? Does the chairman of the board, you, give your views first, or do others speak and then you give your views?
It really depends on the issues and what we're talking about, and it's sort of up to me. The order changes. It's not an order of seniority or anything like that. People say, let's say we're going to have a go around on the economy. People will say, I'd like to go in the middle. I'd like to go at the beginning. I'd like to go at the end. And we sort of make up a list and we hand the list around. So I will sometimes go first if I really want to make a point. Often I'll go last and I'll try to sum up and then say what I think the path forward is. It really depends on the situation.
Okay. I always worry about secrecy, so I assume that you have somebody coming in and sweeping the room where all these discussions are going to occur, or when they're being done virtually, you have the best cyber people in the world to make sure that nothing leaks out. Is that correct?
That is correct. Of course, we realize that we're a very attractive, target for hacking and cyber attacks of all kinds, and so we invest a great deal of time and money in trying to make ourselves as safe as possible. We also have very strict rules for FOMC participants and their staff for the handling of confidential materials. I would just say you never feel like you've done enough. I'm sure you feel the same way. In business, you just never feel like you've done enough, but we try very hard to be as robust against those kind of penetrations as possible.
You are the first person in quite some time to be the chairman of the Fed who was not a PhD in economics. You've been trained as a lawyer. Is that why you are able to speak in the King's English much better than the economists who've had that job? Because you tend to speak in ways that people actually can understand.
I do consciously think it's very important to speak to the interested public in a way they can understand, and to avoid jargon. Large public and private institutions around the world are really struggling to hold the faith and support of the public. And I think for the Fed, it's terribly important that we do engage with the public proactively. We don't look at this as something we got to do. It's absolutely essential to what we do is to speak to the public and the public's elected representatives in Congress a lot, and sort of gain our democratic legitimacy through that.
Typically, chairs of the Fed will have a regular lunch with the Secretary of Treasury. Sometimes even the President of the United States will have some regular contact. How are you relating to this administration? Do you meet with the Secretary of Treasury regularly, or people on the White House staff, or the President? How are you doing that?
So I think the way the sort of standard way it's happened has been this, that there's a weekly, it had been a breakfast or a lunch between the Secretary of the Treasury and the Fed chair, and it rotates back and forth into each building. That's now a phone call. And so that's what I've been doing with Secretary Yellen. In addition, there's been an irregular but roughly monthly lunch with the head of the National Economic Council, so there's a relationship there. Meetings with presidents and Fed chairs are very, very, very infrequent and not on any sort of a schedule. So I have not met with the president.
Had you met him before he was president? You must have met him at some point in his life or your life, or you really haven't met him yet?
I think I've shaken his hand, but I have not really met him and talked to him.
So when you are running the Fed in a pandemic, are you doing it remotely from your home? I know you're now in the Fed building now, but have you been the last year or so mostly working from home, or have you been coming into the Fed and working from there?
So we had a pretty significant FOMC meeting on March 15th, which I think was a Sunday, and that was the last meeting that I did from this building. That I went home after that, and since March 15th of 2020, have mostly worked from home. And although lately I find myself coming in 2, 3, 4 days a week, as a matter of fact, more than I used to. I'm not sure why that is, but that is the case. And I would tell you, it was surprising how well our business and our business model were able to adapt to doing work remotely. I think many organizations had that experience. We certainly did.
You're coming in more frequently because your wife is saying, finally, it's time to get out of the house and go to the office more. Is there some of that? Or
there may be some of that involved. There may be some of that involved. Absolutely.
I wanted to ask you, what have you learned as a member of the Fed, board member, that you didn't really know before that surprised you perhaps? And what have you learned about the pandemic and the way it's affected the economy that might have been a so-called lesson learned that the Fed has learned about how the economy operates in a pandemic?
Well, I'm just about to have my 9th birthday here at the Fed, so I've learned a lot in those 9 years. I think you have to master the specific economics around monetary policy, and also you've got to master payments and regulation. So there's a lot to learn. In terms of the pandemic, I would say this. The first and most important thing about the pandemic was healthcare policy, which starts with the things that we did to shut down the economy, that not we, but that the government did and that the private sector did to get the pandemic under control, and then to get people to socially distance, and then ultimately vaccines. All of that was and is more important than anything we can do. The second most important thing was fiscal policy. This was a situation where 30 million households are suddenly without an income, and Congress had to replace that. That isn't a matter for monetary policy. It works by stimulating aggregate demand by lowering interest rates. That wasn't that would become important later, but that was not what was needed. It was fiscal policy. Fiscal policy came in and made the difference in this cycle. Then us, we were third, and I think we had 3 goals from the beginning. The first of which was just a stabilize thing, which I think we seemed to stabilize markets after what we did on March 23rd of last year, and also to provide some comfort and then support the economy when the expansion began, and then over the long run try to avoid longer run damage to people's working lives and to smaller businesses going out of business and things like that. So those were the things we tried to achieve. Clearly, we've learned a lot about the way pandemics work, and we hope to know more about that going forward, because we hope to have no more pandemics.